We all know that not all investment properties are created equally, and we have all watched the shows on TV that rarely fills in the parts of the operation that go wrong or the unglamorous aspects of profiting from an investment property. You probably know someone or have at least heard some of the horror stories that can align with fixing and flipping real estate. We want to help our investors avoid making some commonly overlooked mistakes, so we put together a few tips to help you be more successful if you are thinking of jumping into real estate investing and purchasing your first deal. The fact of the matter is, novice investors are often so excited to buy their first deal, they make easily avoidable mistakes which diminishes their long-term profits. Here are 5 tips you should consider to ensure your profits when investing in real estate. Tip number 1, know your neighborhood demographics and statistics. You should complete a thorough analysis of the neighborhood before investing your hard-earned dollars. Depending on your goals, you want to consider both rental goals and fix and flip goals, so you can decide what makes sense for your situation. You want to understand the demographics of both buyers and potential renters in your focus area. Is the neighborhood affluent? Is the area up and coming? Are there shopping centers, malls, and future developments coming to town like a new Starbucks or a new Whole Foods or a strip mall? Look around at the local businesses and get an understanding before you invest. Keep in mind that major retailers pay big money to study neighborhood demographics before they set up shop, so you should too. You will likely find larger markets of prospective tenants who will be able to pay their rent each month if you better understand the demographics of the job market. It never hurts to analyze the household median income averages, the crime rates, and the school district ratings of your focus neighborhoods before you make a decision to invest. Tip number 2, know the comparable sales. You should research what other similar properties in the neighborhood are selling for and how long they are on the market before selling. Make sure the homes you are comparing to your target property have the same number of bedrooms and bathrooms and are within a 10 to 20% square footage of your property. Also take a look at the average days on market, which can be an indicator of how long it can take for your home to sell if you are a flipper with a newly renovated listing to sell. If the days on market is dwindling over time, it might be a great time to buy and resell for a profit, as this shows greater demand in the area. Also look at what properties at other rental communities nearby are renting for, as well as the vacancy rates. Are property managers offering specials such as free rents or other incentives to entice renters into those communities? This could be an indicator that they are having trouble renting out their units. When completing your comps, always look at the properties that have already sold or have already been rented. Simply looking at the listing prices will not provide you with much information, as the listing price can be whatever the owner wants. It does not mean that they will receive an offer and sell it for that price. Tip number 3, risk versus reward. Before making your investment, you will want to analyze your financial risk versus reward. There are several equations investors take into account when considering a real estate investment. Some of these include the 70% rule, which states that you should not pay more than 70% of the after repair value or ARV of the house. If you are renting out a property, you can consider the 1% rule, which states that you should be able to charge at least 1% of the value of that property in rent each month. So for example, if your property is worth $100,000, your rent should be $1,000 a month. While you should always consult with an accountant or other professionals, using these gauges will give you some quick insights into the potential value of a property. Tip number 4, carefully examine the property photos and description. Listing photos can sell a property. However, if there aren't many photos included in the listing or advertisement, it is likely due to the fact that there is not many positives about the property to photograph. Bad photographs or a short description are a very big sign that you need to visit the property in person, put eyes on it, and evaluate it on your own. Or even take your own pictures of the property to analyze with your construction staff or contracting team afterwards. Tip number 5, poorly done repairs or additions. If the repairs to a house were done poorly, whether by the owner or a terrible contractor, you should reconsider your purchase or find another deal to invest your money. Unpermitted renovations could end up costing you your entire budget, so make sure that repairs were permitted, if permits were necessary, like electrical, for example. Poorly completed repairs are often hidden, so make sure you do your due diligence and ask lots of questions during your walkthrough. If the property was not properly maintained for a prolonged period of time, that alone can lead to major problems down the road. An owner who skimps on repair costs is not likely to pay the cost of properly maintaining the property. If there have been additions or renovations to the house, make sure all permits were pulled correctly and that there are no existing code violations.